Good afternoon, everyone. It is 1 o'clock and welcome to today's Mailers Hub webinar. Folks are still coming in, but I'm going to get started here with just some of the usual Mailers Hub webinar housekeeping. As usual, today will be recorded. I'll have that recording available within the next 24 to 48 hours for the Mailers Hub subscribers that will be on the website. As you're coming in, you will see intermittently in the chat window a copy of the presentation as a PDF. You can download it from that chat and we will post it, as I said, periodically, just to make sure that everyone gets a chance to download it. As always, we do welcome questions. We do have a pretty decent audience today, so we will keep everyone muted, but we do ask that you submit your questions using the Q&A feature. For matters of clarification on a topic, we will try and kind of interrupt the presentation and make sure everything is clear and understood. But if for more overall questions, we may wait towards the end of the presentation to address those. So let's get started with the economy. What does 2022 look like? And joining us today is Mr. Jim Dolmas. He is the economic policy advisor and senior economist at the Federal Reserve Bank of Dallas. Jim's main research interests are in the field of macroeconomics, where he has worked on such topics as the costs associated with business cycles, the effectiveness of stabilization policy, inflation measurement, and the politico-economic determinants of inflation, taxation, and immigration policy. His research has appeared in scholarly journals such as International Economic Review, Review of Economic Dynamics, and Journal of Economic Dynamics and Control. Jim holds a PhD in economics from the University of Rochester and a bachelor's degree with honors in economics from the University of Chicago. Prior to joining the Dallas Fed in June of 2000, he taught economics at the undergraduate and graduate level at Southern Methodist University. He has also taught at the University of Rochester and the University of Texas in Austin. Mr. Dolmas developed and maintains the Dallas Fed's trimmed mean PCE inflation rate. In addition to briefing the bank's president on national economic conditions, Jim writes monthly analyses of inflation data for the bank's website. So if there's anybody that can tell us what we can look forward to in 22, I do believe it is this gentleman. Jim, take it away, please.
Okay, well, thank you. Thank you very much. It's good to be here. Good morning, everybody. And just let me start sharing my screen here. One second. There. Can everybody see that in full screen, I hope? Okay, so again, thank you. So the U.S. economy, what's going on? What can we expect? And let me just begin with just a little disclaimer that the views I'm going to present are my own, especially when I get into some of the forecasting about inflation, and don't necessarily reflect official positions of the Fed or the Federal Reserve System or the Dallas Fed. So that out of the way, let me just give you a little overview of what I'm going to hit on. First, I just want to talk a little bit about what this recession and recovery have been like, because it's really one of the most unusual we've seen ever. And there are a lot of features that are just unique to it and worth touching on. And of course, it doesn't really happen in a vacuum. There's been a really big policy response, both fiscal policy and monetary policy. And I'll just talk a little bit about what they've done. And then go into a little more detail on some of the key themes in the recovery. And these are themes that sort of things that we've seen so far, but they also are kind of determinative of what we're going to see ahead. So it's not entirely looking backwards, because these really condition where the economy is going. One is that, the path of the economy still depends on the virus, but its effects, the effects of COVID, have been getting more muted, at least in terms of their economic impact. Secondly, that the labor market, kind of in spite of what we see with headline numbers for, say, the unemployment rate or the number of jobs lost, the labor market's really a lot tighter than those headline numbers indicate. And then inflation in my view is likely to be higher and more persistent than many people expect. And then I'll talk in detail about the outlook for 2022 and beyond, the view from the Fed's Federal Open Market Committee. They recently made forecasts, and you could see sort of what the Fed is expecting over the next several years. So let me just talk about, begin with these, just what a strange and interesting downturn and recovery we've had. We saw really an unprecedented drop in economic activity in March and April of 2020, followed by a sharp rebound that really began in May, so 2 months later. Real GDP, we don't measure real GDP, the economy's output of goods and services at the monthly frequency. But if we did, we would have seen something like a 15% decline over 2 months back in spring of 2020. But it turned out it would be the shortest recession on record because the recovery began sharply in May of 2020. We had the unemployment rate rise by 10 percentage points in 1 month in April of 2020 to 14.7%. And has since fallen back to 4.6% as of October. Those are really, in terms of the size and speed, kind of unprecedented movements in the unemployment rate. Payroll employment, so the number of people working in jobs, fell by over 22 million in March and April of 2020. Then it rose by almost 8 million in May and June of 2020, and a further 10.5 million since then. And then kind of in the recovery after the initial shock, we saw this really interesting phenomena that just doesn't usually happen in these sorts of episodes, which is that kind of the composition of people's spending really got skewed. So the consumption of goods, so physical stuff, mainly durable goods like appliances, television, things for the home, cars, went way up. And services remained, spending on services remained below trend, depressed. Usually we see something like the reverse in a downturn and recovery, where people simply, defer spending on that. I'll just put off buying that new car, or I'll put off these home repairs, or I'll put off these appliance purchases. But in this case, we actually saw the opposite, where those sorts of purchases went way up. Here, let me just show you sort of pictorially. This is payroll employment, and you can see if you compare the 2008-2009 recession, which at the time seemed quite steep decline. The decline we had in the spring of 2020 is just far sharper, far bigger, with the number of employees on payrolls going from a bit over 150 million down to about 130 million in the course of 2 months. The recovery was initially quite sharp and has sort of become a little more gradual over time. And as of October, payrolls are still just under 3% below where they were in February of 2020. Here's what I was saying about the composition of consumption. This is, in this chart, we have real spending, so real personal consumption expenditures. That's what that PCE abbreviation indicates. So it's inflation adjusted. The black line is overall spending. And you can see it sort of returned to its pre-COVID trend, but the composition of it is really skewed. The blue line is that spending on those goods that I talked about. That's almost 12% above its pre-COVID trend. In those sectors of the economy, it's like we're seeing this unprecedented boom. And then the red line is spending on services, which you can imagine, because of the nature of the pandemic, contact intensive sectors, things where people have to meet face to face. Those fell really dramatically, and have only gradually recovered, and are still below their pre-pandemic trend. But like I said, this hasn't all been happening in a vacuum. Monetary and fiscal policy have provided kind of vital support to the economy. Uh, and let me just kind of talk a little bit about what each of these has done. So monetary policy, uh, the Fed cut, pretty immediately cut its overnight interest rate to near zero in mid-March of 2020. Um, and followed that with large purchases of treasury bonds and mortgage-backed securities with an aim of initially kind of calming disruptions in the markets for these instruments, but gradually transitioning into more using those purchases to hold down longer term interest rates and to keep kind of accommodative financial conditions. And then there was a whole slew of emergency lending programs that the Fed engaged in to kind of support the flow of credit to businesses, to households, and state and local governments, and so forth. Most of those have closed. Those were sort of emergency measures, and it wound down. Um, but at the time, back in the early part through summer of 2020, they were important, quite important. On the fiscal side, we saw this almost really incredible fiscal response just in terms of its size. Over $5 trillion in fiscal support for businesses, households, state and local governments, other entities through a combination. I mean, if you think back to the news over the last year and a half, you may remember the CARES Act. There was a Response and Relief Act, the PPP Enhancement Act, and then in the early part of this year, the American Rescue Plan. All those providing things like enhanced unemployment benefits, providing income support checks to households and things like that. It's just quite a massive response. Let me just show you kind of visually some of the impacts of this or other ways of visualizing the response here. This chart shows growth in the Fed's balance sheet. So this is the assets that the Fed holds. And kind of prior to, if you go back to the left side of the far left of the chart, before the Great Recession, the Great Financial Crisis in 2008, 2009, the Fed's balance sheet was about something on the order of $800 billion. There were a lot of asset purchases after the Great Financial Crisis and the recovery from that. And then a really sharp increase in the early part of 2020. That was a lot of that sort of crisis mode, those sort of crisis mode purchases where it looked like we were very close to just seeing a complete meltdown in the US Treasury market. And the Fed stepped in with these large scale purchases. And then after that transition to a more gradual accumulation of treasuries, those are the blue shaded part of the chart, and mortgage-backed securities, the green shaded part of the chart, up until that continued. Although at the very last FOMC meeting, the Fed indicated that it was going to start. The economy was in a position where it was now possible to start tapering those purchases off. And then in terms of what did the fiscal response do, this was, one of the most unique recessions in this respect, in that it was a recession where personal income actually went up instead of down. The black line in this chart shows personal income, its percent change relative to February 2020. Normally in a downturn, personal income would go down, would only gradually recover. But in this downturn, because of the strong fiscal support, personal income actually went up. The blue and red bars, those are the parts of personal income that come from wages, from employee compensation, from rental income, from all the usual sorts of income that people get. And you could see those did decline sharply in early 2020 and only gradually sort of started to pick up. But on top of that, and offsetting that decline, were those green and yellow bars, which are the fiscal response. The green is the various enhanced and extended unemployment insurance benefits that were provided. And the yellow is sort of all other government transfers. Mostly the big spikes in those mostly correspond to months where the government was sending out stimulus or support checks to households. And so you can see that, I mean, the effects of those fiscal measures have started to decline relative to the part that's accounted for by sort of more organic growth in income coming from more people working, more people earning wages, and so forth. So now let me turn to, as I said, these sort of key themes in the recovery that have to do with kind of the impact of COVID, the labor market, and inflation. As I said, the virus is still impacting the economy, and I have a quote here. The path of the economy continues to depend on the course of the virus, which I think has shown up in just about every FOMC statement since since the pandemic began, and was in the most recent statement as well. And I think this is important, is that sort of each successive wave of COVID that the country and the economy has gone through has had a more muted impact than the one that came before. People and businesses, in a sense, becoming more resilient in their ability to handle it, and then also as we get into this year, the impact of vaccines and vaccinations. In the first wave, we had really a sharp, as I showed you, a sharp contraction in economic activity. We had a winter COVID wave that was quite large, but its economic impact was really sort of only a modest slowing in the rate at which the economy was improving. And then the Delta wave, which was an even more modest fingerprint that it left on economic activity. And I could show you, I mean, it's probably best illustrated by looking at the impact on high contact industries, the ones that sort of most affected by the virus. So this is a measure of from Open Table of seated diners at restaurants. There's a measure of hotel occupancy, and then the green line, TSA screens, how many people are going through airports. And you can see the huge declines in the spring of 2020, around the winter there. So if you look on the chart from around like November of 2020, December, January 2021, February, you see another decline when we had that winter wave, but much more modest than the first. And then the Delta wave really just led to a very modest slowing or dip in these series, and now they've begun to rebound since Delta peaked. On the labor market, and this is something I have here, some screenshots of pieces that we've written, that I and some co-authors. We have a lot of pieces about the labor market on our Dallas Fed Economics blog, really kind of getting at this notion that you need to look beyond the top line number, like, oh, what's the unemployment rate? It's still much higher than it was pre-COVID. You need to look beyond numbers like that to see that the labor market's really quite tight. Here's what I mean by looking at the top line numbers. So here's the unemployment rate in black. In red is the unemployment rate if you exclude temporary layoffs, and both those remain kind of well above. There's been tremendous progress, but they remain well above where they were, say, in 2019. So you would think, well, the labor market can't be all that tight. Look at the unemployment rate. But a range of other indicators paint a very different picture. If you look at the quits rate, the rate at which people are quitting their jobs, or measures of job switching. Quits sort of are indicators of confidence in the labor market, that people think, well, I'm going to quit my job and go work at a better job. Those are always indicators of a tight labor market. If you look at job openings that are at record levels, and also job openings relative to the number of unemployed are quite high. If you look at surveys of what consumers say about whether jobs are plentiful or hard to find, the difference between those is also quite high. If you look at surveys of businesses on difficulties hiring, planned wage increases, those are quite high. And then on top of planned wage increases that you see from surveys of businesses, if you just look at actual wage growth, that's quite robust as well. And all these things sort of point to a labor market that is quite a bit tighter than you judge from looking at the unemployment rate. And here, let me just show you one of those. This is the quits rate. The red line. Don't worry about the blue line. But the red line is the rate of quits, and that is at a record high of 3%. Which is, kind of indicative of a very tight labor market. Well, I guess I'll talk about the blue line. So the blue line is kind of a measure of excess unemployment, so-called unemployment gap. It's flipped over upside down to line up with quits, but you can see there was a real tight relationship between this sort of measure of slack in the labor market and quits, and now quits are at 3%, and they, the unemployment gap that would be implied by just looking at quits would indicate a really tight labor market. And then on wage growth, here are 3 different measures of wage growth. The green line is the so-called employment cost index that comes out quarterly. The red line is a measure from the Atlanta Fed, where there's their wage growth tracker, where they're basically looking at individual level data on wage changes over the course of 12 months. So, we measure wage growth of a whole bunch of individuals. And then the blue line is average hourly earnings that comes from the same data that the same survey that measures payroll employment. And you can see, and you kind of have to abstract from some of the big swings in the blue line. Those have to do with sort of composition effects when, in the spring of 2020, when there was so much loss of employment in lower wage industries, that really kind of artificially boosted average hourly earnings. And then later, this is in 12-month changes, you see sort of the echo of that in that sharp decline in the blue line a bit later. But sort of the important thing is what they've been doing over the last several months. And there they've been trending up pretty sharply, and they're kind of robust levels. Average hourly earnings growth over 12 months is just under 5%, 4.4% wage growth from the Atlanta Fed wage growth tracker, and then 4.2% from the ECI. And those are all quite high. You'd have to go back to 2007 or so to find numbers that big. And then on inflation, as I said, I mean, it's my view, and is that inflation's likely to remain well above 2%, which is, the Fed's target is it aims for, in the longer run, 2% inflation. It's likely to remain well above that next year and beyond. And this is another area where my colleagues and I have a number of pieces on our Dallas Fed Economics blog, kind of laying out the case for this this view. It kind of starts, we've seen this robust demand for goods that kind of skewed composition of of spending that I talked about back toward the beginning has led to bottlenecks, shortages, supply chain issues that resulted in spikes in inflation in 2021. And we've seen really high inflation rates this year. Initially, those were sort of narrowly based in things like, oh, a lot of it's used cars, a lot of it's appliances, and things like that. And those spikes, which come from these supply and demand imbalances, they should abate eventually. But kind of the important point is that underlying inflation, if you try and think of the underlying trend in inflation, it's likely to accelerate. And we're seeing some evidence of broadening price pressures, including from faster wage growth and shelter costs as well. And here, let me just show you a picture of what inflation's looked like. And this is the Fed's preferred measure, which is the price index for personal consumption expenditures. It's similar to the CPI, but it's a little different in a few ways, but generally tells a similar story. And the blue line is inflation, including all items. The green dash line is what's commonly called core inflation, which excludes food and energy. And both those have really jumped this year, especially over the last several months, last 6 months or so, to where we have the all items inflation rates at 4%, 4.4% on a 12-month basis, 3.6% for that ex-food and energy. You'd have to go way, way back to find ex-food and energy rate of inflation that high. The red line is something we produce at the Dallas Fed. It's our trimmed mean inflation rate, which the idea of it is to really try and get it to abstract from some of the idiosyncrasies that can produce big swings in the other series and try and capture kind of the underlying trend. That's been more stable, but even it has started to pick up, particularly over the last 6 months. This is a 12-month inflation rate. The 6-month inflation rate in that trim mean index is actually 3.1%, so it's noticeably higher. So it has been starting to pick up. And we expect, or I expect, trim mean inflation is likely to increase further. And this is really just, this chart shows the red line is now, it's still at trim mean. It cleared out some of the other series that were in that previous chart. And the dotted part with the little squares is a forecast. And it really just updates. This is an update of a forecast that some co-authors of mine and I put out in one of those Dallas Fed economics pieces I mentioned earlier. And you can see our expectation, my co-authors and I, is that that's going to get up to 2.6% next year, 2.7% in 2023, which again, you would have to go back quite a ways to find a rate that high. To me, this is also a good forecast of where the all items inflation rate's going to be in those years, because these things because the trim mean kind of captures this underlying trend in overall inflation. If you look out 4 quarters from now, 8 quarters from now, that's probably where you can expect the all items or the headline inflation rate to be as well. So what that sort of is saying is that putting that together is, inflation is likely to come down. The all items inflation is likely to come down somewhat from where it is this year, but it's still going to remain significantly above 2% over the next few years. So let me just turn to the outlook for 2021 to 2024 from the FOMC. And 4 times a year, so the FOMC, which is the Federal Open Market Committee, the monetary policy setting body of the Fed, they meet 8 times a year at half of those meetings, so 4 times, which correspond to the end of each quarter. They release what is called their summary of economic projections, where members provide forecasts for GDP, for unemployment, and for inflation. Most recently, following the September FOMC meeting, was the most recent one of these SEP exercises. The next one is going to be published after the December meeting, which is around mid-December, I believe. Some of these, I'm going to show you some of the projections. Some of them, these projections, since they are from September, they're probably, they're a little stale now, given some of the data that's come in since, especially the ones on inflation. But the kind of broad patterns probably haven't changed that much. And I think those sort of broad patterns are important, important to look at, important to understand. So here's the latest set of projections for the FOMC for 2021, 22, et cetera, and then also for what is called what they refer to as the longer run, which is sort of once whatever's happening in the economy kind of settles down and resolves itself, where do you see these things coming? Where do you see these things coming in at? So, and the projections are for real GDP growth, which is done on a percent from Q4 to Q4, so end of year to end of year. The unemployment rate, where do you see it averaging in the fourth quarter of the end of each of these years? Overall, all items, PCE inflation, Q4 over Q4. And then they also forecast that ex-food and energy, that core inflation on a 4-quarter basis. And so real GDP growth, which is kind of a broad measure of economic activity, is expected to slow next year, but it's going to slow to something that, if this happened in any other time, right, in normal times, pre-COVID, to a rate that you would consider to be like extremely robust. I mean, we haven't had a whole lot of 4-quarter GDP growth of 3.8% in the, say, the 10 or 15 years prior to this last recession. So, slow from something really rapid this year to something slower, but still quite rapid next year. And then slowing a bit further in the years after that. And then, this idea of, well, what is it in the longer run? That just sort of comes from thinking about structural factors in the economy. GDP depends on how many people are working and how productive they are. We know growth in the labor force over the longer run is projected to be around something like 0.5% per year. Productivity growth is hard to forecast, but is likely to be something less than, on the order of 1.3%, which is sort of what it averaged over the 10 years prior to the recession. Put those together and you have 1.8%, something a little less than 2. So, these years, 2021 to 2024, you see this slowing, but all of those are still years in which the economy is kind of projected to grow faster than its longer run potential. The unemployment rate is expected to come down quite a bit, 3.8% next year, and then 3.5 the year after that. PCE inflation. Again, the view from the FOMC, at least as of September, was that it would come down to something closer to 2% than what I showed in my forecast. Of course, we've gotten new data on inflation since September. Maybe members of the FOMC will revise their forecast somewhat. But even so, the contours kind of qualitatively are similar to what I was showing, in the sense that I expect headline inflation not to continue to be between 4% and 5% per year next year, but to come down, just not to come down quite as far as the members of the FOMC are predicting or were predicting in September. Of course, there's always a lot of uncertainty and a lot of risks around any of these forecasts, including the ones from the set projections, including the forecast I showed you for inflation. There are kind of downside risks to economic activity. Obviously having to do with the virus. But also had to do with, say, supply chain disruptions, bottlenecks, things like that. If those extend longer into 2022 than people expect, growth could be constrained. So growth in GDP could come in a bit slower, and inflation a bit higher. And in fact, I mean, one way of thinking about the difference between the forecast that I showed you, my inflation forecast, versus what the FOMC has here, is that one aspect of it is that I expect some of these bottlenecks and disruptions to extend maybe a bit longer or be a bit more impactful, so that we have somewhat higher inflation, somewhat slower, but still robust real GDP growth. Of course, there are upside risks as well. These bottlenecks and things could dissipate faster than people expect. Also, going back to thinking about that income, that personal income slide I showed toward the beginning, people have, with spending sort of restrained and income growth robust, people have a lot of accumulated savings. The pace of economic activity going forward, there's a kind of upside risk if people start spending down that accumulated savings really, really rapidly. So that's the outlook. And with that, I guess what I will do is stop, because I'm sure you probably have a lot of questions. And I'm going to stop sharing the screen too, but in the PDF that you have, there's a QR code, which our communications and outreach people love to get feedback on how these outreach events, how we're doing. So if you have time, they would greatly appreciate it if you would follow the link from this code and kind of give your feedback on what you've seen today. So with that, I will stop sharing the screen, and I'd be happy to take any questions that anyone might have.
Pardon me. Well, folks, the Q&A section is open. As Mr. Dolmas just said, please use the Q&A feature in Zoom there to submit your questions. One question that kind of occurred to me, I guess kind of a point of clarification. The CPI index tends to have an impact on Postal Pricing Authority, and you had mentioned how the PCE is similar to the CPI but different. But do they typically move in the similar trend? So if the PCE is taking a jump, would it be reasonable to think that the CPI is going to take a jump?
Yeah.
Okay.
Yeah. Yeah. Over time, they tend to move together. Right now, the CPI is running a lot higher than the PCE. And that just has to do with some of the idiosyncrasies that have to do with how much weight they place on, say, durable goods or auto purchases. Those weights may differ across the two indices and may occasionally lead to gaps between them. But generally, over time, they tend to go up and down together.
Interesting. I know pricing is a hot topic when it comes to the Postal Service right now, as is labor going into the peak season. So it'll be interesting to see how the figures you showed with such a tight labor market affect some of the seasonal hires for the Postal Service. Hopefully they are able to get the people they need in there.
Yeah, hopefully. And I should say, I pointed to a whole bunch of economic indicators that I said point to tight labor markets. But on top of that, that's all I hear when I talk to business people. It's there's also a lot of anecdotal information behind that as well. If you just talk to basically really almost any, I haven't met, I haven't talked to somebody who owned a business who has said, no, we're not having any problem hiring people. It seems to be a problem. It seems to be a problem that's widespread, finding workers. So
I can attest to that. It seems like everywhere I go right here in the DC area, everybody's got a hiring sign out. So, well, I don't see any other questions. I do have one attendee here that said nice presentation and said thank you. Oh, here's another question. Can you comment on worldwide trends? Is inflation likely to occur in the developed countries, less developed?
Yeah, I mean, I can comment a little bit. It's international economy is not one of my specialties, but broadly speaking, yeah, in terms of the developed countries, and we're sort of seeing that now. Inflation, say in the euro area, has started to pick up. Inflation in the UK has started to pick up. Not quite to the extent here, but sort of relative to their experience, which I guess to kind of set the stage, I mean, say in the euro area, inflation has been extremely low for a long time. Where after the great financial crisis, they really never got out of. I mean, the Fed got to the point in 2015 or so where it's like, okay, now we can start raising rates again. In 2018 or so, now we can start shrinking the size of our balance sheet. The euro area never really got to that point at all, because they had this kind of stubbornly, worrisomely low inflation that they were trying to that they were trying to support. They didn't want to fall into like a deflationary spiral. So they always had sort of very low inflation. So even though what they're seeing right now isn't quite the same level as it is here in the United States, compared to what they're used to, it's quite high. As for developing countries, yeah, I think we're seeing that also as well. So yeah, it's pretty broad-based globally, I think.
Well, excellent. Well, I don't have any other questions right now, but while I wrap up, if anyone has any to think of, please feel free to type them in. If everyone's had a chance, please make sure you get a chance to download the handout there. It's in the chat box. If not, we can go ahead and post it one more time. As I mentioned, we've been recording, and I'll have that recording available within the next 24 to 48 hours. I would like to thank Mr. Dolmas. Thank you very much for all the information you shared today. The economy is kind of a scary thing right now. So couple that with the Postal Service, 2022 can look a little uncertain, but with this information, hopefully we can make our plans a little bit better. Right now, we don't have any webinars on the docket for December. We'll be back in January of 2022, unless the Postal Service does something fun and exciting and we need to put a session together for you real quick. Thank you again, Jim, for your help today, or for your presentation today. Thank you also to Jennifer for running the webinar in the background there. And everyone have a great afternoon. Take care.
Thank you.